In 1974, even after America abandoned the gold standard in 1971. That version is not entirely wrong. But the parts that are imprecise matter Underpinning the dollar's post-gold standard global dominance was a secret agreement that the United States government actively concealed from its own citizens for 4 decades. Now understand why it was worth concealing, because what it actually purchased for the United States was extraordinary. Saudi Arabia by the mid-1970s was the world's largest oil producer. When it priced its oil in dollars and accepted only dollars in payment, every country on earth that wanted Saudi oil, which was effectively every industrialist economy, needed to obtain dollars first. China needed dollars. Japan needed dollars. France needed dollars. India needed dollars. Germany needed dollars. The entire non-communist world needed American currency to access the most essential commodity in the modern industrial economy. That created a permanent, structural, globally distributed demand for the US dollar that had nothing to do with gold and everything to do with energy. The dollar had lost its gold backing in 1971. By 1975, when all OPEC member nations had followed Saudi Arabia's lead in pricing oil in dollars, the dollar had acquired something arguably more powerful, an oil backing. Not formal, not treaty-based, but practical and inescapable. You could not buy the world's most critical commodity without first obtaining American currency. This gave the United States what French Finance Minister Valéry Giscard d'Estaing famously called an exorbitant privilege, the ability to run persistent trade deficits, borrow at lower interest rates than any other country, fund military operations, social programs, and technology investments simultaneously, all without facing the financial constraints that discipline every other economy in the world. The mechanism was the one that Kissinger had engineered. Control the currency in which the world's most essential commodity is priced, and you effectively control the terms on which the entire global economy trades, saves, and borrows. That architecture has been the foundation of American financial power for 50 years, and it is now under structural pressure of a kind it has not experienced since it was built. Let's be precise about what is actually happening, because the popular narrative on this, in both the alarmist and dismissive directions, tends to significantly overshoot or undershoot the reality. Saudi Arabia joined BRICS in 2024. The significance of that decision is real and should not be minimized. The country whose oil pricing arrangement has underpinned American financial dominance since 1974 has formally aligned itself with the bloc whose explicit institutional purpose includes reducing dependence on the US dollar in international trade. In 2023, Saudi Arabia's finance minister publicly stated at the World Economic Forum that the kingdom was open to settling oil transactions in currencies other than the dollar, including euros and the Saudi riyal itself. Saudi Arabia has joined Project mBridge, a digital currency settlement platform developed with China, Hong Kong, the UAE, and Thailand, a cross-border payment infrastructure that operates entirely outside the SWIFT network that underpins dollar-denominated global finance. In 2023, China completed a yuan-denominated oil purchase at the Shanghai Petroleum and Natural Gas Exchange. As of 2025, Russia, Iran, Venezuela, the UAE, and portions of Gulf Cooperation Council trade are participating in varying degrees of non-dollar oil settlement. None of this means the petrodollar is ending tomorrow. The facts on the other side of the ledger are real and deserve equal weight. The dollar still accounts for approximately 80% of global oil trade invoicing. Saudi Arabia currently holds approximately $144 billion in U.S. treasuries and has been increasing those holdings in recent periods. The Saudi riyal remains pegged to the dollar, which creates a deep structural incentive to maintain dollar relationships, because any move away from the peg carries enormous domestic economic risk. The yuan is not freely convertible. There is no deep, liquid market for yuan-denominated assets remotely capable of absorbing the surplus earnings of major oil exporters the way the U.S. Treasury market has for 50 years. The practical obstacles to displacing the dollar as the primary oil pricing currency remain enormous. But here is the precise point that both the alarmist and dismissive analyses consistently miss. The question is not whether the dollar gets replaced overnight. The question is what happens to American financial conditions as the share of global oil trade settled in dollars gradually declines, from 80% towards 70%, towards 60% over the course of the next decade or two, because the margin is where the structural danger accumulates. The petrodollar system gave the United States what economists formally describe as seigniorage privilege at global scale. When the world needs dollars to buy oil, it needs to earn them or borrow them, which creates structural demand for dollar assets, which keeps U.S. interest rates sustainably lower than they would be in a world where the dollar competed on equal terms with other currencies. Every percentage point of that structural demand that erodes means American borrowing costs are marginally higher than they would otherwise have been. Marginally higher borrowing costs on $36 trillion in federal debt, which grows by approximately $2 trillion per year at current fiscal trajectories, is not a marginal problem. It is a trillion-dollar problem that compounds annually and does not resolve itself through any mechanism short of genuine fiscal adjustment or currency debasement. The deeper historical pattern here is worth understanding clearly, because it has played out before in ways that carry direct lessons for the current transition. Every global reserve currency in modern history has eventually been displaced, not in a crisis, not overnight, but through a slow structural erosion of the advantages that made it dominant in the first place. The British pound was the anchor of global finance for most of the 19th and early 20th century. It was not dethroned in a single dramatic event. It was eroded over decades by the excessive debt accumulated during 2 world wars, by the rise of a more dynamic American economy that gradually absorbed the trade and financial intermediation functions the pound had performed, and by the loss of the imperial and colonial arrangements that had ensured pound-denominated transactions across a quarter of the globe. The pound did not collapse. It simply mattered less, year by year, until the moment arrived when it no longer mattered enough to anchor the global financial system. That transition took roughly 40 years from the end of World War I to the formal establishment of dollar dominance at Bretton Woods in 1944. The dollar is following a structurally similar trajectory, not toward collapse, but toward reduced dominance. And reduced dominance for a country that has built its entire fiscal architecture on the privileges that reserve currency status provides is not a comfortable or cost-free adjustment. It means higher interest rates than the market currently prices. It means inflation that cannot be fully suppressed by central bank policy alone, because it is partly imported through commodity prices and a currency that is gradually losing structural support. It means the slow withdrawal of what that French finance minister called the exorbitant privilege, the ability to spend more than you earn indefinitely because the world needs your currency to conduct its business. The historical irony is pointed. Nixon closed the gold window in 1971 and replaced gold backing with oil backing through a secret arrangement the public would not learn about for 4 decades. The consequences of that arrangement are now playing out as the oil backing itself begins to erode, driven in significant part by the same structural forces that destroyed Bretton Woods: excessive debt, persistent deficits, and the rise of economic powers unwilling to indefinitely accept the terms of the existing arrangement. So what does this mean practically, and what should a serious investor be watching? On gold, the central banks buying over 1,000 metric tons of gold annually are not making emotional or ideological decisions. They are making a precise institutional calculation. If the dollar's structural advantage as the oil pricing currency diminishes over time, the real purchasing power of dollar reserves held by foreign central banks becomes less reliable. Gold, which has preserved value across every major currency regime transition in recorded economic history, through the collapse of Bretton Woods, through the decline of sterling, through every episode of fiat currency debasement in the modern era, is the historical alternative that sovereign wealth managers reach for when paper currency dominance becomes uncertain. Central bank gold accumulation at these levels is institutional capital communicating something that retail investment portfolios have not yet fully priced. On commodity exposure more broadly, when oil and other primary commodities shift even partially toward non-dollar pricing mechanisms, the inflation feedback loop for American consumers changes in ways that are difficult for the Federal Reserve to address through conventional monetary policy. Commodity prices that were previously partially constrained by the structural dollar demand created by the petrodollar system become exposed to dollar weakness in new ways. Energy producers, base metals miners, agricultural exporters, and companies with pricing power tied to physical commodities all behave differently in a world where structural dollar demand is lower than it has been for 5 decades. On time horizon, This is not a 2026 crisis. The petrodollar architecture will not collapse this year. Saudi Arabia is not going to announce tomorrow that all oil must henceforth be priced in yuan. The transition is structural and generational in its pace. But structural, generational transitions are precisely the kind of development that rewards investors who identify and position for them early. Because by the time the mainstream financial press treats the erosion of petrodollar dominance as a settled, obvious fact rather than a speculative concern, the repricing of assets to reflect that reality will already be substantially complete. The opportunity is in the window between when the structural shift becomes visible in the data and when it becomes consensus. The arrangement that has underpinned the dollar's global dominance since 1974 was built on a secret diplomatic cable in Riyadh. It was confirmed to the public in 2016 through a Freedom of Information Act request. It is now under active, documented, measurable pressure from the countries and institutions whose participation made it work in the first place. That is not speculation. It is the publicly available record. The only meaningful question is how many people have read it carefully enough to understand what it implies for where we are heading. Stay informed. Stay grounded in the historical record. And watch what the institutions with the longest time horizons are actually doing with their capital, because that is where the structural story is being told most clearly.